Welcome to the Become Sensible podcast, where we discuss practical accounting, finance, and tax for everyday business. I'm your host, Fiona, and I'm here to show you that no matter what your business financial situation is, you can change it. Good morning. Welcome to the podcast Become Sensible, where we break down complex financial topics to help you to make the better financial decision for your business. I'm your host. My name is Fiona, and I am CPA for business owner. Today, we dive into the topics that affects all of us. It is tax. And I know we all have a bigger relationship with this topic. Tax is complicated. Tax is boring. Tax is a mundane thing that we need to talk about. But we pay roughly around 30 to 35% of our earnings for income tax. And then after that, we need to pay for property tax, sales tax. So roughly around 40% of our earnings is going into the tax. And so it will become the biggest expense of our lifetime. So tax become essential. And if you do not do it right, the more you earn, the more you pay in tax, and it's put you in terms like a higher tax bracket. So today we will discuss how you can save in terms of tax or pay less tax legally. And before we dive into the topics, because it's a sensitive topic, all information that we provide in this podcast, this episode, is for educational purpose because financial and tax needs to be tailored to your situation. We cannot just generalize advise you. So even though I am a CPA and the information that I research about it and I share with you, but this cannot be like a financial advice or tax advice on a podcast. But all of this information, I think is very important for you to know, to understand, and you can ask a specific professional tax accountant to help you to tailor to your situation. So now let's dive into the episode. And we always start with the basic thing. So your earning, your income normally need to pay the first three things. Number one is federal income tax. And then after that is Social Security. After that is Medicare. So federal income tax, it has tax brackets go with it. Depends on how much you earn. And then after that is Social Security, Medicare. Normally is a 15.3%. But if you work for another company and you are employee of another company, your employers need to pay 50% of that amount. And then after that, you pay 15% of it. But if you own your own business, that 15.3% is on you to taking care of. And after that, depends on the state where you live or your primary resident. You need to pay state income tax. And there's around 9 states in the United States doesn't have an income tax like Alaska, Washington State, Texas, Florida, Tennessee, a couple of them. So 9 of them. And beside all of these 9 states, the rest of the United States need to pay state income tax. So it depends on the state if you live. It's around 5% to 10%. And if you live in New York City, it's probably one of the highest tax rate in the country because you need to pay for the state income tax and then city income tax. So it's almost 1.5 times than other people average tax if they live in other place in the country. So there's one of the misconception that many people think that the more you earn, the more you pay in tax. But normally, our tax system is called progressive tax system. It means that, for example, as a individual earners, here's how the tax bracket will look like. So your tax rate will be 10% on the first $11,600. And then will be 12% on the income from 11,601 to 47,150,000. And then 22% on the income from 47,151 to 105,525. And then 24% from 105,525 to 191,950. And then 32% from 191 to 51 to 243,725. And then 35% on the income over 243,725. So understand this is very important in terms of tax strategy and tax planning. Because for example, if you earn like $150,000 is your total income from the business and from other sources. I make a round number so easy for us to understand. Even though that 150,000 it fall into the tax bracket 24%, but it doesn't mean that you will pay 24% of all income. Instead, you will pay 10% on the first 11,600,000, and then 12% on the next 11,601, and then 22% from 47,000 to 151 to 100,525, and then 24% from the final 105,525 to 150,000. So your total tax will be around 29,041. And this make your effective tax rate around like 19%, not 24% at all. Understand this is very crucial in terms of tax planning, because if all the tax strategy work together that help you to like have your adjusted gross income that not jumping into the new tax brackets or is not into like the higher tax brackets, you save a lot in terms of tax. So for example, if on your earning you have a W-2, which means like you work for your own company and you become like employee of your company, is you a W-2, like for example, like $50,000 per year. And then you have like net profit from the business, and then you have earning from rental property or other thing. But the W-2 earning is a core earned income, so there's no deduction come with it except like the retirement contribution, which I will talk later in the episode. If you have other income that help you to like all the schedule on your tax return, it moves your tax brackets. Instead of report $150,000, it helps you like take the deduction and the loss from other schedule that make your tax totally, instead of $150,000 in adjusted gross income, but it moved down, it's like $100,000, $120,000. In some way, you will pay less $10,000 in tax every single year. And that's just why it's very important. And I know we cannot talk very detailed in that case because it's like have a lot of strategy go with it. So now we move on to the next thing. And then I hopefully that you will understand the way that I present it. So then we all need to pay like Social Security and Medicare, which is normally total Social Security Medicare is 15.3%. But if I work for another company or you work for another company, your employers will pay half of that 15.3%, which is around like 7.6% for you. And then, but if you work for your own business, if it's a single member LLC, a sole proprietor, you basically need to pay that totally 15.3%. This is why some of the business need to become an S corporation, because as you become the employee of your own company, an S corporation will pay half of your Social Security Medicare on the salary that you pay for yourself. The rest of it, the net profits from the business, you don't need to pay Social Security and Medicare tax anymore. So the business itself can take that deduction in number one. Number three is the amount of 15.3% only like apply for the amount of salary for you to pay. For example, if you make $150,000 and you pay yourself like $50,000, I mean, in the net profits, you decided you pay for yourself $50,000. That 15.3% only apply on that $50,000. The net $100,000 after that, you don't need to pay Social Security and Medicare tax. But if you only sole proprietors and single member LLC, you need to pay all of this. Of course, in the formulation of the Form 1040, it has is above the line, they take half of your deduction, half of the self-employment tax, and then they add it back. For example, if your business make $150,000 above, 15.3% will be like $22,950. That make your total tax from federal income tax is $29,000 plus $22,000. It's $51,000. And I think this is where many business owners that sole proprietor and single member LLC, they surprised because totally tax deal is like become like $51,000. They couldn't believe that self-employment tax kick in at the end when tax calculation, the last part of your Form 1040, it will kick in this self-employment tax. And that's why make many people like underestimate in their tax. So this is where is the thing that you need to pay attention in the structure of your business. And that is why we move on in terms of the entity structure. It depends a lot in terms of your business goal. Do you plan to sell your business? Do you plan to raise funds from outside investor? Do you plan to issue like common stock, like go on to be like IPOs? Do you want to or you just want to be like your own business and you don't need outside investor like many small business owners chose. So it depends on what is your end game, your future long-term game. Because like this, if you want to raise funds from outside investor like venture capital, or you want to go on to become a public company, like go IPOs on the stock markets to raise the fund for your business or have an outside investor, you cannot become an S corporation because S corporation is just limit for 100 shareholder. If you have more than that, you can't. And that is why most of the time people, if they want to raise in the future, they want to sell the company with a huge amount in capital gain. They want to select the entity as a C corporation because with C corporation, you can raise fund and have more shareholders. And then also they can take advantage of qualified business, small stock. Thus, in the future, if they sell the company with the huge capital gain, they can take advantage of it that reduce their capital gain tax when they sell the business. And that is why understand what is the plan in the future for your business. It have a lot in terms of tax strategy too. But you say like, okay, if I just want to run a small consultant company or service providers, a marketing agency or something like that. I don't need raise fund. I don't want to sell this huge capital gain and all of those. Maybe S corporation is a suitable business structure for your company because it helps you to reduce your self-employment tax, which is Social Security, Medicare tax, which I just mentioned above. And so understand what is your end game of your business that help you a lot in terms of choose the right entity structure for your business and save you in terms of tax. And then after that, the strategy number 2 is maximize your deduction as the business owner. If you want to serve the business, as long as the expense is served for the business purpose, you can take the deduction. Of course, it's not like all luxury items. They have a certain rule that come with this. Like if you buy a luxury car, is section 179. They actually have a like certain limitation how much you can do up to certain amount of money. So depends on the specific situation. The rule will like tailor that for you. But there's normally around like at least 40 common deduction that a business owner can take advantages. So make sure that you know these common deduction and talk to your accountant or your CPA that will take a look up your financial report and your tax deduction report on your Schedule C or your S corporation return, and to look at like, okay, where is it? You miss any deduction. Maximize deduction also relate a lot in terms of how you code your transaction to classify transaction. And this is where the correctly bookkeeping coming in. So most of the time I see like there's a lot of not so good bookkeeping. And that is why the business owner cannot like itemize like all the deduction eligible for their business situation. So it end up like there's so many small business that have a very poor in terms of record keeping, bookkeeping. So when the tax time coming in, they don't have profit and loss. We're all line by line deduction. If you don't have all of these and it's in very detail and code in the right way, your accountant, if they don't do the bookkeeping for you, they don't actually can figure out where the thing is. And that is why need to have a very good bookkeeping on record. Like for us, like we do the bookkeeping for many of our tax clients who are business owner. Because of that, we have a very detailed line by line of expense. And thus, I see on my personal experience, I see hundred of business, and I can say that a good bookkeeping can make your business from profits to a loss because it's track all of the expense that your business actually eligible for it. And from a profit to a loss, it can cut you $10,000 in tax, like easily. Because like you see that self-employment tax already like 15.3% of your net profits. So from like profit $100,000 to be like profits just $70,000 or like $50,000 is a lot of things different in terms of like how much you will pay in terms of tax. And so make sure maximize your deduction and have the right bookkeeping financial report on record to help you to like maximize your deduction. Number 3 strategy is retirement contribution. Many people think that, okay, if I work for myself, I cannot open retirement contribution and there's no tax benefit for doing so, which is completely wrong. As a business owner, there's policy and regulation that actually give you the credit, the chance, the opportunity to contribute for your retirement. So there's 3 retirement that you can do. Number 1 is called SEP IAA. I call it the word SEP IAA, but the whole word of it is stand for Simplified Employee Pension Plan. So you can contribute up to 25% of your profit from the business. And then there is a thing called solo 401k. Solo 401k is applied for the business owner that doesn't have any employee at all. And it works exactly like how you work for another company and they offer the 401k. So your business actually can match your contribution. And on your side, at the employee side, you also can defer up to like $23,500, depends on your age, every single year to contribute to your retirement. And why contribution for retirement is super helpful as the business owner? Because, so for example, as a SEP IAA, 25%, like for example, the business makes $100,000. 25% of it is $25,000. That you can basically defer that earning. Your business now just report a net profit $75,000. And if you think like if you take 15.3% of $25,000, it's a lot of money. This is like 25,000 multiplied for 15.3% is around like $4,000 in terms of tax saving for you if you contribute to your retirement account, which is, I think, normally when you contribute to your retirement account, depends on the type of retirement account that you open. It saves you around 25 to 30% in terms of tax, which is a huge amount of money because if you do it continuously for the next 20 years or 30 years, that can become a portfolio that worth $1 million. And you don't do that. You take that money and you pay the tax to the government, which is unheard of. But I think like many business owners don't actually aware of this. I see a lot of new clients coming in have this problem, that they just send the money to pay the government. Now, while government actually have a policy that help you and encourage you to do this thing, because if you contribute for retirement is the way that it's actually invested back into the economy. And so they encourage and they give you the tax benefits, but so many business owners never take advantage of this part at all. So that is SEP and a solo 401k. But if your business have employee, which is W-2 employee, depends on like the retirement plan that you set up. But you can defer on the employee side of your part. You can defer all of the earning or like max to up to 23,500. And then on the employer side, your business will match your contribution exactly like the way that you work for another company. So you can contribute to up to like $64,500 per year, defer your earning. How much that tax is saved for you? I say it never actually 10,000, but it is even like 20, 30,000, depends on your earning. So if you overlook this, you lost a lot in terms of tax saving. So for example, if you go back to the example, $150,000 earning, if you contribute $1,000 a month for your pension, that is $12,000 per year. Now this reduced to your taxable income is to $138,000. And this will make your tax bill go down from $29,000 to $26,000. That's you save $3,000 right away in terms of like tax. But this is, I just make a random number, general number, so that it's easy for us to make the calculation. And then on your business side, the business can match like $10,000 every single year. So that make you to contribute like totally make your profit from the business go down to $128,000. This will also save you a couple $1,000 more in tax. So, I know the techniques of it, how to do is more go into the detail, how like depends on the plan that you set it up and how execute it. But I mean like in general, it would save you easily $10,000, like $7,000 or $10,000 in terms of the last couple 3 strategy already save you at least $10,000 in terms of tax every single year. But of course, it depends on the tax brackets, the income that you make. Some of the people can save like even like 20, 30, or even $50,000 per tax year. And if you take that money to investors, I cannot say how much that you will save in a lifetime. And then the next strategy is defer your income. Life depends on like tax brackets and how you know whether like your future earnings, your next year or your future earnings, whether it will be higher or whether it will be in a lower tax brackets. And that help you to have the strategies in terms of like defer the earning. Instead of earn now, you can earn in the future in terms of capital gain, in terms of like the business earning. That depends a lot in your specific situation. But defer earning is all one of very popular of tax strategy. And then the next one, we talk about tax credits. Like small business owner, the most popular thing is we call qualified business income deduction. That is up to 20% of your qualified business income. But then it has the limitation depends on the industry, specific business service such as doctor, lawyers, or accountant. And also limitation, they have a threshold and formulation. Calculation depends on the W-2 pay to employee, your household income, which tax brackets that you fall in. So that is very specific, but you can easily to get like tax credits like 20%, up to 20% of it's like $15,000 in terms of QBI deduction. And then you can have energy efficient, other tax credits depends on the industry, such as like R&D's research. Like I know many IT service company, they can apply for R&D credit because they basically write a new software, develop the new process or something like that. They can apply for the tax credit. And then have an energy efficiency vehicle, and then a small business retirement account. Like if you set up the 401k, solo 401k, all this also can get you some credit in terms like small business retirement. And then the next one is the tax advantage of using real estate investment to help you in terms of like lower your tax brackets, and because it's have other deduction code like the section 179 in terms of depreciation and all of the other rule. And real estate tax, how the real estate will help you in terms of your tax strategy, we probably need to talk in a different episode because it's like so much more go into it, and it's reserved to have its own episode. So before we wrap up, I want to emphasize the thing is very important. Why will this strategy help you to save money? Tax laws are complex and they change all the time. Like for the last 4 years since COVID, since 2020, there's so many things that's changed in terms of tax brackets due to the inflation. So many things going on during the time. And so that is why very important that you have a great qualified tax professional that on your side. And also not only they have the knowledge, but they actually need to care about your situation. I know so many always accountant. They just find the information that you give them. They just find exactly the information. They never give you the advice. When they look into your number, they say, hey, there's other thing that you can do to help you to mitigate this tax liability, because there's the rule that you can use it to help you like save the money. They don't take a look into it and they don't advise you. So you need to find someone that actually have a knowledge of all of these tax rule and regulation and changing, but also someone actually care about your situation. And I think like in our business, our company, we call that tax planning, that they actually look at the situation and give you the strategy and advice that help you the best in your situation. And I know many people will say, why it costs so much money to have a great, excellent accountant and advisor? Because if you think about it, if you every single year you save a simple case, you save $10,000 in tax, you take that money and you invest it in the next 20 year or 30 year, that actually create you millions of dollars from saving $10,000 in tax every single year. People never actually put in that way. But if you save $10,000 and put it away and invest it with 10% return on your investment in the next 20 year, 30 year, that's worth millions of dollars. And I actually see some people actually doing it, that they started it with just one business and now they have a 3-4 business and they have a ton of property that make them in the amount of time, 15 to 20 years, make them worth $5-10 million if they do it right. So I'm not overestimate the result of this thing can change your wealth and your network in the future. But that's why if you have someone who the best in the work that they do and they care about your situation, you can save a lot of money and it's actually contribute for your wealth in long term. So to sum it up, the key takeaway on today's episode is number one, understand how tax brackets really work. You actually not better time by moving into higher tax brackets, but if you don't have a tax strategy, it will actually make you pay a lot of tax. But if you have it right, it's actually save you a lot regardless how much totally earning that you make. Number two, choose the right entity structure depends on your business goal, your personal goal. Number three, maximize your deduction. And that is why very crucial to have a right bookkeeping. Number four, have a retirement contribution. Number five, defer your income. Number six, tax credit. And finally, that talk about real estate investment. And it deserves its own episode. So if you found this helpful, please share it to your friends, your business bestie, so everyone can benefit from it. And remember to subscribe to our podcast and leave the comment and any question that we can help you more in terms of tax or your business financial topic. Until next time, this is Fiona and I appreciate your time.